Thank you so much, Juan, and thank all of you for coming this afternoon, giving up this nice spring day, evening. We are very grateful to the Vinson Centre and Juan for offering to hold this seminar, and to the IEA to make available to us this historic building where I have so many happy memories meeting great economists such as F.A. Hayek many years ago. Yes, déjà vu. I have that feeling now when I listen to current explanations put forward by central banks and others of the reasons for inflation today. We're hearing again all about shortages, energy price rises, excessive wage demands, rather than excess supply of money. It reminds me very much of the 1970s and the resistance put up by central banks and the establishment generally to discussing inflation in terms of money. People who believe that money matters also, as in the 1970s, are split today. There are those who believe in monetary base, that monetary base matters, notes and coin and bank balances with the central bank, and there are those who insist that policy should target some broad money aggregate. Just to complicate matters further, I warn you that we are going to introduce another category of money this afternoon. This is what we call super money, and Brendan will explain that later. We think this is one that really should matter. So, as in the 1970s, the same happened in the 1970s. You had this dispute between the broad money people and the narrow money or monetary base people. I learned my monetarism at the feet of people like Karl Brunner and Alan Meltzer and Anna Schwartz, who have been described as three of the greatest economists who ever lived by another economist recently. And they then believed in monetary base, controlling the monetary base. I think Alan changed his mind later. But it is blunted, I believe it has blunted the message of the monetarists that they have so many internal disputes. Certainly it doesn't seem to be making any headway at the moment. Then I come to 1990, the launch of central banking. If I may, if you will excuse a personal anecdote at this point, when I was a teenager, I suppose I must have been about 16, I remember asking my father, "Dad, what should I do when I grow up?" He thought for a moment and then said, "Nestle as close as you can to the source of the money supply." I never figured out quite how to do that, actually. And then he grinned. Maybe he was speaking tongue-in-cheek. But the nearest I got to that is starting central banking, discussing other people who are close to the source of the money supply. Now, central banking has certainly not been a license to print money. But 1990, when I launched it with two colleagues, was a very exciting time to launch a venture in this space. The Soviet Union was in process of disintegration, along with its command economy. In October, West Germany and East Germany were reunified. Many countries had to get used to dealing with money and markets and market-determined prices. It was what they called, as you remember, a period of transition. Central banks were caught up in that. All these states had to, as you will remember, modernize their state apparatus. Central banks were an important part of that. And central banking publications and the seminars that we held and the training courses that we held played, I think, a small part in helping those countries to modernize their central banks. The world was engulfed in a period of enormous, fast economic, political, and financial change, leading to a much wider role for markets in the economy. Within a short period of time, many central banks around the world changed from being subordinate, inward-looking, tradition-bound institutions, subordinate to the government, to being powerful, outward-looking institutions with considerable autonomy. I won't say independence, with considerable autonomy. Personally, I had got to know many central bankers by this time, both when I had been editing The Banker in the 1970s, and also when I was director of the Group of 30 in New York. I knew people like Jacques de la Rosière, head of the Banque de France and the head of the International Monetary Fund, Paul Volcker, Alan Greenspan, and so on. Robin Lee Pemberton, then governor of the Bank of England, kindly gave us an on-the-record interview for our first issue. Other governors followed suit, and in the world of central banking, that was all important. In short, we believed that a modernized central bank would be an agent of liberation for many countries around the world. It was an optimistic time. Once central banks had got the hang of things, they could control markets through market mechanisms and help the economies to grow without excessive inflation. But fast forward 30 years, I have the latest issue of central banking over there. Fast forward 30 years or so, and we have to say these hopes have ended in disappointment. Yes, there have been successes and many individual achievements, including those which are recognized in central banking's annual awards to central bankers. Nobody is saying that life has been easy for central bankers. But after so many mega boom-bust episodes, high inflation, and in many countries, meager growth rates, central bankers are struggling. They're struggling in their most important aspect, which is to keep the trust of the public. Do they have the trust of this public now? They keep on reassuring us that everything is all right, but more and more people find this hard to believe. They also face stinging criticisms from people who know the business, former central bankers, including former presidents and governors of central banks around the world. Jacques de la Rosière, who I mentioned before, has been extremely critical of the European Central Bank. Someone like Ottmar Issing in Germany has been very critical also of the European Central Bank. Thomas Hoenig in America, and even Mervyn King here. So central banks are really on the spot now. So what has gone wrong? How do we fix it? These are the questions that Brendan and I address in this book. But before we come to those, we need to have a clear idea of what we mean by good money. What do we mean by good money system? And that forms the next part of our presentation. Thank you very much.
At this part of the presentation, I'm going to launch with the topic, what is good money? But I do want to stress that any ideas I'm talking about here are absolutely joint creations with Robert, and we've discussed these over many years before we got down to writing this book, and it's really impossible to distinguish which ideas came from where. They are absolutely joint. So good money, first of all, must be good for the individual. And what I mean by that is it must perform well the traditional functions of money, most of all store of value, medium of exchange, and deferred unit of account. And there's absolutely no trade-off between money which is good at the level of the individual and money which is good at the level of society. Money which is good for the individual, and the better it is for the individual, the better it is at the level of society as a whole. It is possible for money to be too good, which I'll come on and discuss later, that you can't expect money to deliver a high rate of return. That's just something which in general equilibrium in pricing you're not going to get for something which is such a good and safe and liquid asset. And you're not going to have money so good that it is constant purchasing power every week of the year. In fact, if you were to have such money, as I will explain, which was always constant in value, you would end up with instability in the system, which ultimately undermined the quality of that money at the level of the individual. Now, I come on to a concept which Robert has already mentioned of super money. A good money has at its base a group of assets which have extreme qualities of moneyness, such that individuals are willing to hold large amounts of this, even although it pays no interest. And what I would, in a fiat money regime, super money qualities, when we think of banknotes or reserves at the central bank, are high, always liquid, always realizable, and always realizable at par. Under a gold regime, when you talk about super money qualities, the immediate realizability into the yellow metal is a fundamental quality of that moneyness. Point number 3, good money has a solid anchor which prevents it from getting out of control. And I quote J.S. Mill here. Many of you will be familiar with Milton Friedman's quotation from J.S. Mill that most of the time money doesn't matter, but when it gets out of control, it becomes the monkey wrench in all the other machinery of the economy. So the function of a solid anchor is to prevent money from getting out of control. And if we think of another way of today's language of describing getting out of control, it means monetary inflation, of which the two main symptoms are goods and services inflation and asset inflation. And I come on to discuss these terms in more detail as we go through here, but enough to say at this point that both those concepts, goods inflation and asset inflation, require quite a lot of thinking about. Goods inflation cannot just be measured by CPI increases, and asset inflation certainly cannot be measured by whether asset prices are going up or going down. Point number 4, a solid anchor depends on scarcity and super qualities of base money. So what I mean here is that for an anchoring system depends on the amount of base money which has these super money qualities being scarce, and also those super money qualities being unique to base money. They haven't been spread around other assets. They mustn't be too scarce, just like good money mustn't be too good. If you were in a monetary system where base money is the super money assets are rarely scarce and in very amount only to 0.1% of GDP, then it would be impossible for that to be an anchor of a system. So it's very important towards establishing solid anchor that the base money enjoys broad and strong demand, and that depends on the quality of its super money attributes. But it's also important that the base money with these qualities is kept in short supply. That may sound a bit of a riddle, but I come on to discuss that in a bit more detail as we go through this presentation. And I would just go back to what Robert was describing earlier as the debate back in the 1970s as to whether we should be targeting base money or broad money. The point I'm trying to make here is I'm not taking base money as some sort of dictionary of economics term. Base money with super money qualities to be in broad, strong demand and in scarcity requires a very specific type of monetary system about which you will hear more today, but certainly involves a lot of innovations and changes from what we have. So we're not saying in this book, go out and take base money as it is today as your pivot. We're saying that in a good money, base money would be such and have the qualities that are needed for it to perform that solid anchor role. But the base money on the dictionary definition that you see today could not perform that role. And point number 5, no income and super money. The monetary base, whether in the form of reserve deposits at the central bank or in gold systems, in various gold certificates, must not pay interest. And that point needs a lot of consideration, especially in today's world where all central banks, ECB, Federal Reserve, are paying interest on reserves. If money, super money, is to be scarce, a measure of that scarcity is the fact that people are willing to hold it in large amounts, even although it's paying no interest. If this base money asset is paying interest at the market rate, at the margin, almost a tautology, it's not giving you any super money qualities. And if, in fact, it becomes powerless because changes in the amount of this super money or monetary base outstanding, if you're in a situation where the marginal super money quality is 0, in fact has very little influence on anything. So for the base money to be a strong attachment as part of the anchor, you would have to see a positive interest rate to tell you that it was in scarce supply. And in fact, as Forrest Capey would tell you here, I think if you go back to the history of what most people would see as a reasonably good money system between 1870 and 1914, I don't think in London the discount rate in general, the money market rate, would ever get below 1 or 2%. In fact, we have a famous statement from Bagehot that the Englishman stands for much, but he goes mad if interest rates come below 2%. So in that good money system, base money is always in such short supply relative to a really large and strong demand that you see perpetually significantly positive interest rates. We come on to the next point, competition in good money. Competition is essential as part of a good money system, and I would mention 2 aspects where competition is important. One, you have to have the production of safe deposits. Now, safe deposits in a good money system don't depend on deposit insurance or too big to fail or lender of last resort. Safety comes about through competition to produce deposits which have high backing of monetary base and well-capitalized banks, so that essentially this super money is held either directly in the form of cash or in case of a metallic standard gold, or it's held in the form of safe deposits where individuals are effectively holding deposits which are very highly backed by the super money asset. Now, the second sense in which I say competition is important is good money systems are fundamentally corrupted once you have any sort of general cronyism where central banks or governments are handing out privileges of liquidity to generally, and hence undermining and diluting the quality of the monetary base of the system. And that essentially has happened all along to some degree, whether it's with reserve banking, where there's a lender of last resort, does lead critically to a dilution of that quality and inevitably becomes prey to corruption in various forms. I come next to the question of convertibility into a real asset or fiat constitution. Robert and I had many discussions about how far we should mention gold or not gold as the preferred system, and we generally came to the conclusion that we should put both forward and leave a reader to decide, and in practice the journey from one to the other is going to be long in any case. But the attraction of a convertibility where the money is convertible into gold or alternatively a real asset is two or threefold. First of all, on the supply side, you have a geological or mining restriction which helps to keep the supply scarce. Secondly, you have some automatic mechanism which tends to shift supply in line with real shifts in demand over the long run. And thirdly, and very importantly, where there's a real asset or gold convertibility, it enhances the broadness of the demand for this monetary base, because in effect people are holding some sort of gold reserve-backed deposits, which fundamentally there's going to be a stronger demand for than where the only quality of your safe deposit is that it's backed by banknotes in the central bank. And then I come on to two very important points for recognizing a good money. And I sort of hinted at it already. Natural rhythm of prices. What I mean by natural rhythm of prices is if you have a good money system under which over the very long run purchasing power tends to be maintained, it certainly does not mean that over short and medium term periods you get constant purchasing power, because a good money allows prices to fluctuate in a natural rhythm, and that natural rhythm of prices plays a very important role in intertemporal equilibrium in a capitalist economy. I'll give you just two examples of this. In a good money system, prices fall to a lower level in a recession, and they rise to their peak price in a boom. Now, the fall of prices in the recession to a lower level means that consumers and businesses can anticipate higher prices in the future. So that is one reason for them to bring forward spending, and it's an automatic mechanism for the economy rebalancing itself. Another example is, as we had recently with pandemic or war shortages, if prices rise during that period of shortage, but everyone expects, because you've got a solid anchor, that prices will come to a lower level after the shortage is over, then in fact you produce an incentive for people to delay consumption during the shortage and push it forward into the period where there's going to be abundance. We're not talking in the good money system about having inflation rising to 10% and then coming down to 2%. That's a complete joke in terms of good money system. Good money system would mean during a pandemic you had prices going up and then they come down. And so in a good money system you have that natural rhythm of prices. Finally, I want to say that in a good money system you have a free market in interest rates. You don't have interest rates perpetually being administered and fixed by central banks. Instead, the short-term interest rate is highly volatile and determined in an overnight market, demand and supply for monetary base. And the long-term interest rate is determined at millions of micro decision-making according to the rate of time preference and marginal rates of return to capital. So the long-term interest rate is your informative rate, and the short-term rate is highly volatile. And I would just make one extra point here, that if you have a natural rhythm of prices, where prices fall during periods of rapid productivity growth when real interest rates are high, and the prices rise during periods when productivity growth is very low and real interest rates are low, you end up with much less fluctuation in interest rates over time than in a system where central banks are trying to keep inflation at constant 2%, which again makes money a much better deferred standard of value. So I think that's enough about good money at this point, and I'm going to pass the discussion back to Robert to discuss some of the symptoms of bad money.
Back to bad money. Here we summarize the harms of money regimes in modern democracies. They are not necessarily present in all cases of bad money, but they are typical and common. The overriding feature is a mega financial boom-bust cycle. The boom phase can be highly elongated and conjures up illusions of prosperity. Now, I won't go through all of these, it would take too long, and you're probably familiar with the general, you get the gist of what we're trying to say here. Short-termism is a characteristic feature of the current monetary system. People are aware that the next big crash and recession looms as a larger risk the further out they look. So there's a great pressure to get deals done now, things done now, not less. You never know what's going to happen in the longer term future. The impact of this short-termism is magnified by widespread financial engineering, which means essentially high debt and leverage. And there's a cumulative loss in the value of money, a loss of trust in money. It's seen, for instance, in the growth of crypto, demand for crypto assets of various kinds. Artworks, substitutes for money, can play the same role as money. The lack of trust in money. Growth of zombie companies is a familiar complaint. Increasing inequalities of wealth. And outbreaks of international currency wars, as each country fears that a depreciation by its neighbour will cause it to lose exports and employment, and therefore they try to match it by depreciating their own currency. Manias. You have manias in the stock market or in tokens, tulip bulbs, and so on. Increasing fears of government default, as now whether the United States, which I don't believe it will, where we've been through this many years, it will, in the past, the United States always comes to a last-minute settlement on its debt ceiling. But still, it's a sign of the terrible catastrophe that would happen if the United States did default. Breakdown on market discipline on banks to efficiently and cautiously allocate credit. And also there's kind of compulsive, hysterical focus in the media on what central banks will do next. This is surely absolutely harmful to calm discussion of policy. However fundamentally trivial, the media are obsessed with guessing what X or Y central bank will do next, especially the Fed and the Bank of England and the ECB. Powerful people with powerful interests, especially in the private, for instance, the private equity space, sometimes, and bankers, sometimes welcome regulation as if it was a price worth paying to make their vast profits acceptable socially. This regulation deflects pressure for more fundamental reform that would threaten their profits bonanza. Banks employ armies of box tickers and form fillers to prevent them suffering huge reputational damage and fines, which would result from lapses in compliance. But I think Brendan's going to deal with a couple of things at the bottom there. But first, before I pass it over to him, I'd like to say that modern money, in general, these harms add up to one lesson. Modern money is not a secure basis on which people can plan their lives, buy a house, get married, raise families, and save for retirement. It has corrupted capitalism. For many citizens, their life chances and fortunes depend far more on networking through cronies and affiliations to powerful groups than on their enterprise and initiative. It makes us all anxious. And I believe if we've got time, we can go into it later. Modern money detaches money from any sense of underlying value of an object. If prices are moving around, even if a central bank succeeds in hitting a particular index, 2% inflation for a particular definition of prices, what about all the things that are not in the index or that are not priced? These can wander around in a very volatile way, so that people's idea of fundamental value is eroded. You need long-term price stability to establish in people's mind what is a fundamental value of things, which are not necessarily in the price index.
Yeah, so I'm going to take on the last 2 points. Malinvestment, which you get under a bad money system. Malinvestment basically describes the faulty investment decisions or faulty allocation of capital which comes about due to the corruption of capital market signals by monetary inflation. So that in a system where you have an episode of monetary inflation which may lead to, in particular, long-term interest rates being far away from where they would be under a good money system, and also leads to the generation of highly speculative narratives which tend to have a life of their own. This can all lead to extended episodes of investment going into areas which, under better signaling, wouldn't happen. And the result of that, as a tendency over the long run, would be less economic efficiency and prosperity than you would get than if the capital market signaling were uncorrupted. This sort of comes back to a point I was mentioning earlier about asset inflation. I like to give an example when talking about asset inflation of many of you will have read Thinking Fast and Slow by Daniel Kahneman. But a fundamental idea there is that if you have a choice between a certain loss in a bet or a certain loss or taking on a bad bet whose actuarial value is even worse than a certain loss, almost everyone that Kahneman had in his sample goes for the bad bet. So that's an example of where in a regime where you have maybe enforced low or negative interest rates, that you lead to a distortion of market pricing. So I very much have that in mind, in addition to just looking at the more traditional discussion of where interest rates are in the bad system relative to the good system. I come on next to the no natural rhythm of prices. In a bad money system, you're likely to see none of the natural rhythm of prices I was describing earlier. And in fact, what you will see is the very opposite of that. And I would just quote 2 or 3 examples, and we have a history chapter in the book of periods when prices should have been falling if there had been a good money system fairly persistently, but instead of prices, because there was rapid productivity growth, but because the central bank at the time was trying to stabilize prices or generate 2% inflation, they ended up over a long period of time having interest rates which were well below so-called equilibrium and stimulating these sort of asset inflations and malinvestments. And the periods which we quote in particular in the book are to some degree the well-known example of the US in the period 1923 to 28, when there was the second industrial revolution occurring, and yet the Fed was trying to stabilize wholesale prices, and hence interest rates remained far too low for far too long, creating vast asset inflation, of which a key aspect was the lending boom into Germany, and as we all know, that ended up in a fantastic bust. In more modern times, of course, we had the rapid productivity growth of the IT revolution in the period 1996 through to 2003-4, and again, central banks trying to prevent inflation going negative or falling prices and ending up with large asset inflation. I extend this discussion of bad money to take account of what we see as 4 key points. First of all, bad money regime advances monopoly capitalism and economic sclerosis. What do I mean by that? Well, under a regime of enforced low or negative interest rates, we observe this hunger for yield. And of course, where can you get better yield than an enterprise which is promising you a long-run stream of monopoly rents? So you, under that bad money system in an asset inflation period, you tend to get giant premiums on any asset which looks as if either actually or potentially it's going to become a generator of monopoly rents. So that gives any such company an advantage through a very cheap cost of capital in being able to create a zone of destruction around it. And of course, in this most recent 10 or 20 year period, economic innovation and technology has been such as to give that sort of tendency even more momentum because of all the natural type of monopoly effects that come with digitalization. And so we've seen that exacerbated. And growth of monopoly capitalism together with the malinvestment, which I was describing on a previous slide, explain much of the economic sclerosis which we had in the second decade of the 21st century. It was a puzzle to many economists and commentators as to why interest rates were so low for so long with no strength apparently in the economy. But one way of explaining that is through this advance of monopoly capitalism and economic sclerosis. Now, point number two, in a bad money system, you have vast monetary taxation in different forms. And the two different forms of monetary taxation we discuss in the book are, first of all, the well-known inflation tax, where a sudden rise in prices, which is not anticipated, leads to a real loss on holding of government bonds. And of course, we have now this farcical discussion, which Robert was alluding to, of whether the US is going to default for 3 days on its payment on reserves, on bonds, treasury bonds. When anybody looks at the economic reality here, US, together with a whole list of other foreign countries, has made real defaults on its inflation tax collections, on its government debt, which are of the order of 20% plus during this same period. But in addition to that well-known inflation tax, we have a less well-known but nonetheless important type of monetary tax, which is what we describe in the book as monetary repression tax. And that comes about through the bad money regime, bringing about a level of interest rates which is persistently lower than what it would be under a good money regime. And to give you an example of that, I mentioned earlier a natural rhythm of prices, where prices would fall during the recession and go up during the period of rapid expansion and boom, that meaning that over the cycle as a whole they were flat. Now in that world, money holders can expect substantially positive real interest rates. What we have had instead is that there's never been price falls during recession. In fact, during the last great recession of 2008, 2012, the effort was to produce inflation at 2% even during the recession, which means that there's no real bonus to money holders at the start of a recession. There's only loss later on through potential inflation. So that's a world where there's enforced negative rates. And the difference between what rates would be under a good system and bad system is what I refer here and what we refer to in the book as monetary repression tax. I come third to what's a key idea, which is this vicious circle of asset inflation and banking crisis. Asset inflation, which we've been talking about, leads on sometimes to banking crisis. And how does the political system respond to banking crisis? It responds by putting safety mechanisms in place, such as too big to fail, enhanced lender of last resort, enhanced deposit insurance, all of which undermine what we presented earlier as being critical in a broad demand for good money, a broad demand for base money. All these safety mechanisms mean a corruption of the anchoring system, so that the anchoring system, after these safety mechanisms are put in, become less satisfactory than before, and the likelihood of going into another enhanced asset inflation becomes even greater. So you get into this vicious circle of asset inflation and banking crisis, and one example of that we give is a way back from the beginning of the century, 1907, and then going on to the great crisis of the 1930-33 period. Fourth, what keeps a bad system in power? Very big topic, but I would suggest a few things. That if a system is so bad, how does it stay in power? big tech and big finance like bad system of money. As we explained, big tech monopolies have gained from bad money. Certainly big finance, private equity gain from bad money. And of course, big government gains from bad money. And I think it's important to bear that coalition in mind when we try to explain what keeps a bad system in power. At which point, I think we transition to what many of you may have been waiting for, is what to do about the bad system. And I'm going to let Robert lead in there, and then we take over after that.
We do not advocate one particular solution to all these problems. We outline for the readers a range of possible alternative journeys towards a better system. We know there are going to be great start-up costs. We know that it's most unlikely that what we're talking about is going to happen anytime soon. How will it happen? We do not go into that in detail. But the outline we've given surely suggests that this situation in the long run will become intolerable. Whether it happens through a rapid inflationary episode, that the debt gets so big that it can only be solved by rapid inflation, or whatever the actual route may be, we believe it's useful now to set out a range of alternatives for when the crisis happens, and we need to go to a different monetary system. So we believe there are several courses that the state could take in that situation. One is a fiat money system with a solid anchoring based on constitutional rules, as outlined by people like James Buchanan in his public choice contributions. Fiat money system based on constitutional rules restricting the supply of money. So the monetary authority or central bank, or whatever it may be, is mandated to follow certain rules. This could be presented actually as an extension of central bank independence. Central bank independence is supposed to insulate money to some extent from the whims of the state. It could be presented as going beyond that, forcing the central banks, forcing the monetary authority to follow certain rules, which was much of the original insight of monetarism in the 1970s, was that a pre-announced simple rule was the best basis for monetary policy. This would put this into law, at the constitutional level. B, you could have a fiat money system with a settled link to a relatively stable foreign currency. This is the familiar currency board system in place in several countries, which is described by people like Steve Hanke in great detail. This is good for countries with such weak political systems that they find it difficult to maintain any kind of currency stability. They can go for a currency board anchored to a relatively more stable currency, such as the dollar or the euro.